Today we are going to discuss about the continuational, about the reversal movements. On phase one, we actually discussed about the continuational movements where the price actually was creating new highs or new lows. But today we are going to discuss when the market creates maybe a reversal, what are you going to do with scenarios that happen like that? So now we are going to discuss about shift coordination. So when we talk about shift, we mean by this term. For example, shift point is where the market breaks below the previous validation and violation. Recently, first of all, we had this as a validation point, as a validation point. Also this as an invalidation point. But when the market comes and closes below this invalidation point, it is where now we know now that this bullish trend is invalid. That's why we call this an invalidation point. So it's the point where we know now that this bullish trend is now invalid. So now the market has entered to a transition phase. This is what we call a transition phase. The market has entered in a transition phase. So we are waiting for the price to create a new area of liquidity so that we can take our movements. So how do we spot these shift points now? Let us try to look on how to spot these shift points. For example, the market, first of all, when on a bullish case scenario, you have to observe the lowest point first. And as you can see here, this is my lowest point. This is my lowest point. So I have to come to the left side and try to observe the previous validation and violation that the market later on came and closed above. As you can see, as after the market closed above this area, now this is what we know as the shift point. So this is the shift point. The previous invalidation point where the market came and closed above this level by a candle closure is what you know as the shift point. So that is how we observe the shift. Also, another example, here we have the lowest point, which is this one. If you come to the left side, we have this structure right here, marked by this rectangle. So this was our previous validation and violation, as you can see here on this, yeah. So later on, the market came and closed above the violation point by a candle closure on this candle right here. So there is where our shift point is located. Also, we have this example here where this high on previous candle here, previous structure, we had this previous validation and violation. Later on, the market came close below this level. So this is our invalidation point. The market came close below. That means that we have a shift point that is located on that area. But also we have this one. We have the lowest point here, clearly. To the left, we have this previous validation and violation or previous structure or previous area of liquidity. The market came and closed above this invalidation point of this structure here. That is where this trend, this bearish trend is now invalid. We are entering on a transition phase where we are going to actually change the phase or change the perspective. Also, we have this example here, we have this highest point. On previously, we had this structure right here. The market came close below the structure, close below the invalidation point. That means that we are actually shifting or we're actually changing the course from an uptrend to start going down. So that is how we observe the shift points. Also, we have this example here with the lowest point here. On the left side, we have this previous structure, which was validation point, and here my validation point. Later on, the market came closed above this invalidation point, meaning that the bearish trend is now invalid. So we are entering to a new phase. If there's any question so far on this validation on how to spot these shift points, you may ask.
No question. You can continue.
Okay. So let us now discuss shift on basic level. So when the market actually performs a shift or performs a transition, this is what we call a transition, a place where the market starts to change, but we're not 100% sure that the market is actually changed, because sometimes the market may come and continue to create new highs and form structure like this. So it's better to wait, but the price has a tendency, after the market performs a transition, the market has a tendency of coming upward to this area to find this. Actually, this is not an area of liquidity. This is just a point of interest. I think there was typing error on this area. So the market has to come to this inside this point of interest in order to find areas of liquidity that are available on this area right here. So now this is the main difference between the break structure and the market shift, as you can see here, as I have explained on the previous examples. So this is how the difference between the break structure and the market shift. So now let us discuss shift on basic level. Shifts coordination on basic level. So now when the market performs a shift, the market has to come this area to find liquidities. So for example, the market maybe has performed a shift on the weekly time frame as my orange, as indicated on this key. The market later on has to come inside. Then after the market has to perform also a shift on the 4 hours time frame. We have weekly point of interest. If the market comes inside this area, the market has to perform a shift on the 4 hours time frame, meaning that on constant time frame, we are moving. Actually, we are having a bullish idea. Also on 4 hours time frame, we're also having a bullish idea. So this is very powerful. The market has to perform a shift on also on the situation time frame. So this is actually when you're trading based on this environment, we're trading a lot. We're trading we're trading confirmation entries. We're trading entries with highest probabilities. Also, when the market later on comes again to the 4 hours point of interest, then after performs a shift again, now is where these 3 time frames are talking the same language. So we are taking entries based on very low risk, or that means time frame, and you are taking the rewards based on the highs from the weekly. So you may actually have a risk of 10 pips, but take almost a reward of 1,000 pips sometimes 100 pips. So that is how we trade this thing. This is just a skeleton. I'll come show you on real charts. But also we have the types of shift based on the formations that the market actually was offering when performing that shift. So you have types of shift based on the structures. So first of all, we have the inside formation. This is what we call an inside formation. For example, the market performed a shift and left us with this area of liquidity right here. This is what we call an inside formation, or its abbreviation is an INF, an inside formation. So now this is very, very powerful because
I have a question, sir.
yes, you can ask.
Most of the time, I see that there has a lot of inside motion.
A lot of, sorry?
Lot of inside motion I have seen most of the time.
Of course,
How
the
can
market actually
how
performs a lot.
which one is the
How can we?
how can I choose which one will be mitigate?
Of course, we will come to discuss it clearly on the liquidity consumption concept. So
Okay.
right now we just have to observe these ones. So now this is my inside formation. After the market performed a shift on this time frame here, on this shift point, this was my area of liquidity. So this is very powerful because it is the area of liquidity where we came and changed this direction of this market, because the market was actually having a bearish participants, as you can see here. But this now is an area of liquidity where it participated on forming or on changing this perspective of this price, which is very, very powerful. And also a lot of liquidity is being located on this area. So this is also what known as inside formation, or it was also an area of liquidity. It's where we are going to take our entries. I'll come to show you clearly on the charts. Also, we have this both inside formation and outside formation. So now, if you observe something like this, first of all, you have to observe something like this. For example, if the market forms both inside and outside formation, if you were to use the inside formation, you'd have to consider liquidity consumption. You have to see if the market came and tried to grab some liquidity before it went up. So if for the case of this tested inside formation, actually here you have to use the outside formation as your area of liquidity, but also you may also use this portion which is left from this downward portion right here, which is left, that is vector unmitigated. The market also may have maybe some chances of also coming to this area right here before it continues to move up as usual. So that is how we deal with these areas. But if these areas are, or both of them are fresh, we are also having a lot of probabilities of the market to come to this area right here, because there are a lot of liquidities located on this inside formation right here. But based on experience, I actually use both. Sometimes the market may come and tap to the inside formation, because actually we are not banks, we are not financial institutions, we don't know how much volume is located on this area. We don't know how much orders are located on this area physically. So we have to trade on probabilistic way. We are going to use both. If the market comes and stops me out, I'm going to take a loss. I'm going to wait for another opportunity from this area right here, where I know the market won't disappoint. So that is how we deal with these situations where the market performs both of the formations. Also, we have this one, an outside formation only. This is just like the inside formation. We are also going to use this as our area of liquidity. So that is how we trade. But now let me try to show you. Let me try to show you what we call a trend convoy skeleton, on how this on what type these cycles have to move. For example, maybe we are having a shift. We know that the market is a slave to liquidity. So for example, we are having a shift on the monthly time frame. For example, let me try to illustrate it clearly. For example, we are having a shift on the monthly time frame. Consider this a monthly time frame. For example, we are having a shift. Also, we are having an inside formation. For example, this as my shift point, and also this as my inside formation from the monthly time frame. So in order for you to know that the market now is coming downward, in order for you to know for certain, you have to observe the shift from the daily time frame as its situational time frame from this area of liquidity. So we are going to wait for the market to perform a daily shift and left us maybe with this formation, for example. So now we know now that we are actually going down to come to fetch this liquidity that are actually available on this monthly time frame. So on daily time frame, as you can see, we also have an area of liquidity, for example, as you can see here. But also, the market cannot come to the monthly area of liquidity before it fills out all liquidities that are actually available on this situational time frame. So the market also has to shift from the 1 hour time frame so that it can come to the daily area of liquidity before it can continue to go to the monthly area of liquidity. But also, we are also having a liquidities on this area also. The market may not continue its cycle until it completely fills these areas of liquidity. So as a result, now we are going to also have a shift on 15 minutes time frame. But a lot of times we are not considering these 15 minutes time frames because there are actually a lot of noise on these areas right here. But the market is fractal. So what the market forms on the monthly time frames is actually happening also on the lower time frames. So as a result, now the market will later on come to fill this area of liquidity from 15 minutes time frame. Also come again, fill this area of liquidity from the 1 hour time frame. Later again, the market goes now to the daily time frame to fill the liquidities. Then after now, you're going to swing your entry. The market goes down now to the monthly time frame to fill these liquidities. And the market after reaches on this area, the market continues to go up as usual. So when you go to the monthly time frame, actually you may see something like this. Just the market came, then the market went. But on the molecular structures or on the lower structures, this is what is happening. So you have to take advantage of these movements. A lot of people asking me, bro, how do you intraday? Actually, we are intradaying based on knowing we are in what position on this cycle. So I'm going to intraday if I find out that I am in an area of 1 hour, area of liquidity, for example. I know that I'm going to take my entries here. I'm going to take maybe 80 to 90 pips until I reach to my daily area of liquidity. So I know now that if I'm going to reach here now, I'm going to swing now, maybe 800 pips or 900 pips until I reach my monthly area of liquidity. So now that is how this is what happens all day, every day. If you are able to actually know how this cycle works and practice with, you are going to make wonders in the market. If there's any questions so far on that trend convoy, you may ask.
I have a question, sir.
Yes.
Sir, let's say if I do not find a inside formation and shift coordination in monthly, but I found on the daily, can I looking for same way?
Yes, it's not a must for you to find the shift. Also, you may find maybe a normal area of liquidity like this one. Also, the market for example, this is monthly time frame, the market has to shift also to the daily time frame in order to fill the liquidity. Generally, the market has to actually go to fill the liquidities on monthly time frame. It has to shift first to the daily time frame. So it happens all day. Even it's not a must from the shift, but also even these areas, these normal areas of liquidity also, the market has to shift also and come this inside this area to try to fill the liquidities. So it is best for you to wait, sometimes best for you to wait for the market to come to this inside formation here from the monthly time frame. Then after it has to perform a shift on the daily time frame also. This is very, very highest probability setup for you to trade. Then after you're going to continue to go up as usual. So it is very, very important to look the market on that way.
Okay, sir, I understand.
Yes. So let us try to discuss now the first agglomeration, which is what we call a confirmation of liquidity flow. So now, for example, here we have one of the new terminologies, which is reclaim. So, for example, here on this chart, as you can see this example, this illustration, before the market performed a shift here, we had bullish participants that were actually trying to continue to create more highs. But later on, the market performed a shift. After the market performed the shift means that we have new participants, we have new sellers that are actually trying to take down this market. So now this reclaim point here, this is the point where if the market comes and closes above this area by a candle closure, that means that now these previous participants that are the bulls are actually in control again. So reclaim point, it acts as the invalidation point to the shift. So if the market comes and closed above this by the candle closure, we know now that these bulls that actually were the previous participants on this market, they actually came again, they're actually in control for now. So this is how we do it. Actually, how we locate this reclaim point is located on the weak points here, as you can see here. And we named it reclaim point because we know now that these bull participants have come to claim for the second time this dominance of this trend now. That's why we call this reclaim point. Also, we are having this shift point. Also, we are having this area of liquidity, but I'll show you how to trade both this inside formation and also an outside formation. I will explain to you clearly on how to trade them. So now let us go now to discuss this first agglomeration, which is known as the confirmation of liquidity flow. So now, for example, the market has performed a shift on the monthly time frame, and we mark this. So now I need your attention. I need you to focus on this area because it's very, very important. You have to understand it clearly. So for example, the market has performed a shift on the monthly time frame and left us with this area of liquidity, for example, as an outside formation. What we are going to do, we are going to this area right here to find the shift from the daily time frame that happened on this area before the market came down here. So we are going here to find daily shift before the market came down. So if I come to the daily time frame, this was my shift, for example. The market performed a shift and left me with this inside formation. So what I'm going to do, I'm going to mark this inside formation by maybe a rectangle or a line, whatever. Then I'm going to wait for the price to come and tap this area first. So later on, the market comes, taps into that area, and the market has to perform another shift again on the daily time frame. So this is where now the market confirms the liquidity flow. This is how the market confirms the liquidity flow. So after the market comes and taps to that inside formation that was located on this area, taps into it, then performed another shift now. So this inside formation, this one now, it's where we are going to take our trades on this zone right here. So you are going to go to the 1 hour time frame because this is a daily zone. You're going to take to 1 hour time frame to do refinements on this area right here. Then after, you're going to take your liquidity engineering on that level, and you're going to hold that pair for even 3 months, even 2 months sometimes. And sometimes the market went almost 7 months. So it's actually a setup that offers a lot of pips. And it is very, very crucial. It's very, very important. So let us try to go to the real charts now so that we can see a lot of examples. Just try to go to the real charts. Okay. Can you see my screen?
Yes, sir.
Yeah. So for example, this is GBP USD. For example, I'm having maybe this. Let me try to go to the monthly time frame. Try to cut it somewhere here. So for example, I'm having this as my shift point, as you can see here. So after the market performed the shift, the market left me with both inside formation, but also an outside formation. This was my inside formation. Also, I had an outside formation, which was this one. But if you look clearly on the inside formation, the market came and tried to liquidate it, as you can see. So if we were to consider the inside formation, we should have to mark this from this point here, because it is where at least liquidity is available, because it was tried to be washed out by the market on this candle right here. So this was the best area to consider if we were to consider the inside formation. But also let us try to focus on the outside formation first. So now this was my outside formation, and it's from monthly time frame. So as usual, I have to go here to the daily time frame to find the shift point that happened that led the market to go down on this area. So I'm going to find my shift points from the daily time frame on this area right here. So now if I shift to the daily time frame, if I shift, this was my daily time frame, and also this was my shift point located on this area right here. This is my shift point from daily time frame. So I'm going to mark my inside formation, which was this one here. So now I'm going to wait for the price to come to tap to this inside formation first. Then after, the market has to perform another shift after tapping to this zone. So later on, the market came, tap into the zone, as you can see here, and the market performed another shift, which is this one right here. So after the market does this now, this remains to be my best area of liquidity. This my inside formation here is where I'm going to take my highest probability entries on this area. So after marking this now, as you can see now, the market has already confirmed the liquidity flow. I'm going to this zone now to find my liquidity engineering. So I'm going to the 1 hour time frame to find my liquidity engineering. So on 1 hour time frame, just try to go and look what happened on the 1 hour time frame. Let's try to go and observe. So if I come here on 1 hour time frame, I don't know, it's the network issue or what. Let me try to, yeah. So if I come to the 1 hour time frame now to find my liquidity engineering, this was my liquidity engineering, mark it by black. So I'm going to put my pending orders on this area, and the risk was almost, based on structure, it was 18 pips, but I always use 15 pips as my risk. So I'm going to mark my entry there. I'm going to wait. Later on, the price came and activated my entry, as you can see here. So I'm going to take this entry. I'm going to hold this entry. Just try to look actually how the market actually tried to reward this on this setup by almost risk of 15 pips, 14.8 actually, approximately 15 pips. So the market tried to look here how did the market actually try to react on this zone. So the market went a lot of pips. The market went almost, it was 3,000 pips, as you can see here, 3,296 pips. So that is how we trade this confirmation of liquidity flow. Let's try to look at another example. We have the GBP NZD. It was from the weekly time frame. That's where I took my entry on the weekly time frame. Let's try to observe it here. Okay. Let me try to shift this up, because this savers from the forex.com. Sometimes they actually, I don't know how they manipulate these candles. I don't know. So now on this GBP NZD, we had this from the weekly time frame. We had a shift on this area. Had a shift here, as you can see. Also, we had both inside formation, and also we had an outside formation, which is this one. But on this outside formation, we also had a type 1, as you can see here, as an invalidation point. So this was my type 1 area of liquidity. So now I'm going to the 4 hours time frame to find the shift that happened on this area from the 4 hours time frame. So if I come to the 4 hours time frame now, I come to the 4 hours time frame to find my shift points. The market performed a shift on this area. This was my shift point from the 4 hour time frame. So I'm locating my inside formation, which is this one, and I'm going to wait for the price to come and tap this area first. Then after the market has to perform another shift before I can take my trades. The market tried to come but didn't reach. You actually have to wait because you have to be based on the rules. Later on, the market comes and taps to this zone. Then after now, the market performed a shift on this area right here. This was my shift point. So as you can see now here, the market has already confirmed my liquidity flow. So I'm going to use my inside formation that participated in the shift point to try and take my trades. So let me try to remove this line first. So this was my inside formation, foundation point and foundation point. So now this now is the best zone for me to take my trades. I'm going to 30 minutes time frame to find the refinements on this zone. So when I come to 30 minutes time frame, try to look at it, 30 minutes time frame. As you can see here, we didn't have a clear liquidity engineering. So based on the validation evaluation analysis, I'm going also to the 5 minutes time frame in order to look for my clean liquidity engineering, because here it was not actually visible for certain. So if I come to the 5 minutes time frame, try to look here, 5 minutes time frame, as you can see, I had this liquidity engineering, which was also nearest to the validation point. So this was my liquidity engineering. And here now my risk is almost how many pips? Almost 6.9 pips. So I'm going to put my pending order here, my stop loss above that area, and wait for the price to come. Later on, the market came, tap into your entry point, and the market went. I remember this entry I took was almost 350 pips. But later on, we also came and bought again when the market reached to some certain level. I'll try to look at it on this area from the 4 hours time frame. So the market went down almost, it was 300 pips, I remember, this entry. But also, I took another entry based on this level here, as above, so below. I took also a buying entry, and I took it because of the monthly area of liquidity, which was also a type 1, this one. But this now I can't explain because it's on the 5th agglomeration. So that is how we trade this confirmation of liquidity flow. Let us try to look on another examples. Let's try to look another example. Try to look on out JPY. And out JPY, just try to look at it on the weekly cycle. Okay, get the strength first. From the weekly time frame now, on this out JPY, we also took a sell somewhere here. Let's try to cut it this area on this area first of all. So now here, if you observe clearly, I'm having a shift point. As you can see on this area right here, I'm having a shift point. Also, I'm having this formation right here. Mark it by maybe orange. Yeah. But also, if you observe clearly, this formation, the market came and tried to confirm this structure by this movement right here. So now this was our best area to take our trades because it is the area that came and confirmed this structure here. So now if I come to the 4 hours time frame to find my shift points that actually happened on this area from the 4 hours time frame, let's go to the 4 hours time frame first. Try to observe. So on the 4 hours time frame now, I'm having my shift point on this area here. So now this was my shift from the 4 hours time frame. So now I have to wait for the price to come to my inside formation, to tap into it. Then after the market has performed another shift. So the market came and tap into the entry point. So now this is my, if I try to compare these two highs, this was my highest point. So I have to come to locate my shift point on the left side, and this was my shift point located on this area right here. So the market performed this shift now. The market left me with this formation after the market tries to confirm the liquidity flow. So this was my zone where I'm going to take my entries. And try to cut this here so that I can get enough data. So after the market forms this area now, I'm going to the 30 minutes time frame in order for me to refine these entries. So now if I come to the 30 minutes time frame and I observe this area right here, here is where liquidity consumption comes into play. So here I'm having two categories. First of all, I'm having this liquidity engineering from the 30 minutes time frame, but also I am having the zones. As you can see, this zone, the market tried to consume it. As you can see, also the inside one, the market came and tried to consume it also. But I'm having a zone which was actually clean. And this zone was located on this area, if you observe it clearly, this area, because the market didn't try to wash it, didn't try to consume it. So this was my best area for me to also take my trades. So if the market maybe failed to take trades from this area, from this zone, I'm going to use this liquidity engineering as my last hope. So let us try to go to 5 minutes time frame in order for us to refine this entry now. From the 5 minutes time frame, just go to refine this zone. As you can see here, I had this liquidity engineering from the 5 minutes time frame, which was this one here. And my risk was almost how many pips? Almost 3.6 pips. So later on, the market came, as you can see here, tap into the entry point, as you can see, and you are safe by putting the stop loss on 1 or 2 pips above that area. So this was also the entry that we took. This entry, it was on February, I remember. So now the market started to come down. There's something I need to explain here clearly. So after the market tried to come down on this area, after activating this entry by the risk of almost 3.6 pips, maybe 4 pips, okay? If you come and observe to the left side, the market actually performed also a shift on this area right here, as you can see. But also the market left us with this formation here, which was also a type 1. If you observe it clearly, it was also a area of liquidity type 1. So also we came and took an entry on this type 1 here. Based on its refinement, it was located on the 30 minutes time frame. Let's try to look at it from the 30 minutes time frame. That's where the term as above so below comes into play. So this was my liquidity engineering from this out JPY, and my risk was almost 9.3 pips. So coming to the 4 hours time frame. So after we took the sell, this was our first take profit here, and also we took an entry at the same time. Try to pay the price first. So the market later on came and activated the bullish entry. So now this entry that was activated on this area after actually we tried to sell this pair, this entry took the price back again to the zone where we tried to use on confirming our liquidity flow. So later on the market came back again now, as you can see. But also, as long as the market doesn't close above this area, we are going to use this zone as usual. So let us try to play the price to see what happens next. The market later on came and performed a shift. As you can see here, this was my highest point left side. This was my shift point located on this area. So the market came and performed a shift, and the market left me with this inside formation, as you can see, but it was also a type 1 here, as you can see it clearly. So this was my zone. So now if I come to define it on 30 minutes time frame, I'm having this as my liquidity engineering here, I'm in here, and my risk was only how many pips? 6.2 pips. So there is where I'm going to put my entries. There is where I'm going to put my pending orders and wait for the price to come. For the price to come. I'm trying to speed up this simulation so that we can actually save time. The market later on came, as you can see, tapped into the entry point. Then the market now starts to go down, as you can see. So the market went almost, remember it was almost 300 pips. I think it was 200, if not 300. So the market continued to go down as usual. So that is how we trade this confirmation of liquidity flow. If there's any question so far, you may ask. If there's any question you may ask before we move on.
I have a question about a looking for inside information. My main problem is I fail to choose inside information. There has a I'm showing my imagination is working for like this. This one. When after shipping getting shipped,
What you have to observe, you have to observe the inside information that participated on the shift. For example, if this is my shift point, what inside information that caused the shift? It is this one. So this is the powerful inside information to use. As you can see also on this illustration right here from this shift point, because also we had two inside, we had this one also, but also we had this one. But you have to observe what inside formation caused the shift. It was this one. So this is very powerful to take into consideration. So the base inside formation is the inside formation that participated on the shift point.
Okay, if there has no inside information, what will I do? Like if the market give you like a state state.
If there is no any inside information, we do nothing. We actually try to find other setups. We have to try to find the setup that actually meet our criteria.
Most of the time you use like this inside information. If there has no, I see on your in a YouTube video.
On the you're talking about this inside information, for example. If you actually the inside information that is best to use is the one that participates in the shift. But even if you want to consider another inside formations, you have to consider the liquidity consumption. But liquidity consumption, we'll come to discuss it on the FTA. But on this FTA concept, this is just a bonus I'm giving you. I will give you an access to the video on this FTA. Then after you're going to study it. You actually learn clearly on how these liquidity consumptions are actually work. So after learning this liquidity consumption, you're going to know on how to select your areas of liquidity clearly.
Okay, boss. But I have a last question.
Yes, you can ask.
If there has a inside formation and outside formation, what will I choose? Which one will I choose?
There, for on that case, we're going to use both. If the market comes and stops us out to the outside formation, we're going to have inside formation as our last hope. Then after we're going to use the inside formation also. So that
we will use outside formation, right?
Yes, we are, for example, the market forms maybe an inside formation, which is this one. Later on comes and forms another outside formation, for example. We are going to consider this one first. If the market comes and accepts the entry, we're going to take the entry. But even if the market comes and stops us out, we're going to use this inside formation as our last hope. And we know now that is actually having high probability of holding this entry for the market to create a new low. So that's yeah. So let us try to look now on the second agglomeration, which is the normal area of liquidity with validation and violation. Let's try to look at it. This here. Also, before I move on, actually, we have this non-confirmation of liquidity flow. And with this non-confirmation of liquidity flow, actually, it is very, very simple if you understood this confirmation of liquidity flow clearly. For example, let us try to look maybe pairs like Bitcoin, for example. Let's try to look at the Bitcoin. So now let us try to look at the weekly time frame, for example. For example, we are having this as an area of liquidity. Now here I'm talking about the non-confirmation of liquidity flow. We discussed about the confirmation. Now we're discussing about the non-confirmation. So what you have to observe is that if you refer from the explanation, from my explanations on when I was explaining about the basic, how we trade shift on the basic level, this is my weekly rough liquidity and weekly time frame as my constant time frame. You have to observe the shift point that happens inside this area. So it means that you have to wait for the price to come inside first, and the market has to perform a shift on 4 hours time frame, regardless of the liquidity that's actually available in this area. What I mean is that you don't have to look for the confirmation for the confirmation of liquidity flow on this previous area right here. What matters is that you have to come and observe a shift point on 4 hours that happened inside the weekly area of liquidity. So the main difference between the confirmation and non-confirmation is that on the confirmation, actually, if I were to trade these two setups, when I meet the confirmation entry, if I'm going to use maybe one lot size, 1.0 lot size on my confirmation entry, then on my non-confirmation entry, I'm going to reduce a bit, maybe to 0.8 or 0.7 lot size, because we are entering based on the non-confirmation. But all of them actually work, and we trade them a lot. A lot of setups are being given by this one, and the market performs very, very good on these areas. So here, if you observe clearly, we are at the shift point on the 4 hours time frame. Here, this is my shift point, and the market left me with this inside formation, which was actually coinciding between the inside and the outside, as you can see. So yeah, I had this one. So I'm going to find my liquidity engineering on this area so that I can take my entry. So if I come to the 30 minutes time frame, I didn't have any clear liquidity engineering on this area from 30 minutes time frame. Let me try to go and observe it on the 5 minutes time frame. So when I come to 5 minutes time frame based on foundation violation, I'm going to take my liquidity engineering on this area here. So this was my entry point, and my risk was almost 6.8 pips. So that is where we're going to take our entries. That's where we're going to take our entries. So the market later on came, tap into the entry point, then the market started to go down, as you can see. So that is how we trade this non-confirmation of liquidity flow. So actually, the main difference, I think you actually saw the main difference between these two is that from the confirmation of liquidity flow, we have to find the zone on this side here, on this side, from the zone that actually try to shift point on the 4 hours time frame, and we have to wait for the price to come and tap to that zone. But on the non-confirmation of liquidity flow, we actually wait for the price only to enter on our specific area of liquidity and perform a shift on the situational time frame. Then after now, we are going to take our trades based on that trade the market has to offer. So the market went down almost a lot of people before it started to go up. It was almost, I remember, it was almost 342 pips. Then after, the market performed another shift on the day, on the first afternoon, then started to go up as usual. So that is the main difference between this confirmation of liquidity flow and non-confirmation of liquidity flow. Just try to discuss another agglomeration which is very important, which is the normal area of liquidity using the aggressive method or the validation violation methods. So for example, let us try to look maybe on GBP/USD. I'll just try to look it on Oanda. Actually, I like Oanda because he follows the principle of these closures. And let us try to do also a recap on this entry. This entry was taken based on the confirmation of liquidity flow because we had a shift on we had an area of liquidity from the weekly time frame, as you can see here. This entry was from this week. We had this, if you saw on my Instagram, I actually posted this entry. We had this weekly time frame as our constant time frame. We go to 4 hours time frame to find the zone that participated on confirming the liquidity flow. And this was my zone because the market performed a shift on here on this area right here, as you can see on 4 hours time frame. This is my shift point, and this was my inside formation. I had to wait more than 2 weeks for the price to come to this area. The market later on came, tap into the zone, and came again. Now I went now for the shift again for the second shift, and the market left me with this inside formation as my zone. So the entry was taken based on this area right here. But also recently now I took a sell on this area because of the shift that happened on the 1 hour time frame. The shift that happened on the 1 hour time frame, and I'm going to actually explain to you how I took this entry also, and another entry is based on these criteria also. So for example, let us try to look at this pair maybe on the monthly time frame. On the monthly time frame. So for example, let us try to cut this pair maybe somewhere here. So maybe when you came to your charts and you found out maybe the market, let me try to, yeah. And you found out the market maybe is on these conditions. Means that recently we have this as an area of liquidity from the monthly time frame. Now this is the third agglomeration. This is what we call the how to trade this, how actually is actually how to stop the price. But I'm not going to explain it deeper because I actually explain these concepts deeper on those masterclass students. So we are having this as our area of liquidity from the monthly time frame. So you as a trader, you don't have to wait for the market to come here because it may take maybe even 7 months to come here to this area. You have to take advantage on the how I taught you about the trend convoy cycle. So here now, I'm going to wait from the shift that happened on my daily time frame as my situational time frame. So when I come to the daily time frame to find my shift, so that the daily time frame can take me to my monthly area of liquidity. Try to play the price so that we can actually see the shift. As you can see here, the market performed a shift on this area here. So now that means that now I am starting to go up so that I can fill this monthly area of liquidity. So the market performed me a shift. Also, the market left me with these formations here. I had this big outside formation, but if you observe clearly here, we had this movement, the lowest movement before the market came. Also, we have this zone right here, but we took a loss on this zone. It was almost, I remember it was almost, I think it was almost 12 pips from here. We try to refine this now. So now after the market actually came and closed above this area, this now is my daily area of liquidity. This one, as you can see, it's my daily area of liquidity. But also, I don't have to wait for the price to come to this area first. I can, because I know how the cycle works, I have to go to the 1 hour time frame now to find the shift that happens on this area so that I can go down until I reach here before I can continue to go up so that I can go to fetch the monthly liquidities. So I'm going to the 1 hour time frame to find the shift points. So if you observe clearly here on the 1 hour time frame, this was my shift point. This was my shift point. And the market left me with this inside formation. So on this third agglomeration, we are going to use actually validation evaluation to take our entries. So here I'm going to 15 minutes time frame to find my liquidity engineering, which happened to be here on this level. So this entry was activated on this area right here from the 15 minutes liquidity engineering. So now this selling entry is going to take me down until I reach to my daily area of liquidity, until I reach to my daily area. So now here is where you take your intraday trades, and the risk was almost 12 pips, as you can see. So now this entry has to take me down to this area on the daily time frame. But also, even if I reach to the daily time frame, I have also to know where am I going to take my buys so that I can continue to go up, so that I can go to fetch my areas of liquidity. So now, due to non-availability of data, actually I took the trade on this level here because there was some liquidity inducement on this area, but also we had this zone as our subarea of liquidity. So we took an entry based on this liquidity engineering. So if I took a sell on this area, I'm going to hit my take profits on this zone here. And after hitting this take profit, I am going to buy again this level. I'm going to buy again here. So now after buying this area, and my stop loss actually is almost 15 pips as usual. So here is when the market is when we state the as above, so below, and as within, so without. So I know what I'm doing. The market actually, I'm selling this area now. The market later on came down. So you don't have to wait. You actually know the cycle. You have just to act accordingly to how the cycles works. So as you can see, the market later on comes and taps to my entry point and hit TP from the first entry and activated the second entry, as you can see here. So the market now starts to go up. So my first take profit is going to be here from the monthly area of liquidity, but also due to how we manage these trades, you don't have to go out until you observe a shift from the daily time frame. So if I observe clearly here, so far no any shift happened. So far no any shift happened until here. That's right, to continue observing this. So far no any shift happened. The market came and tried to actually clear these liquidities on the monthly time frame, but still no any shift, no any daily shift happening. So you're continuing to hold that price, continuing to hold that price. Later on, the market came and performed a shift, but also left us with this outside formation. So here now is where you're going to take your profits, almost 1,151 pips. So that is how we stock this price. Let us also try to look another example. Let us try to look examples like Euro USD, for example. So on Euro USD, let's try to look at the monthly time frame. Here, let's try to cut maybe somewhere here this price so that we can see how this cycle goes. So clearly, I'm having the monthly as my area of liquidity. So this monthly area of liquidity, I don't have to wait for the price to come here. As long as I know what I'm doing, I have to observe the daily shift so that it can take me to this area before I can continue to go down or whatever. So I'm going to observe my daily shift here. So when I come to the daily time frame, here's my shift. Actually, did it happen for? Just try to play the price again to see. As you can see here now, the market performed a shift on the daily time frame. This was my shift point here. And if you observe clearly, from this point here, I had this area of liquidity as my area of liquidity because it is an inside formation that participated on the shift. So this is the best to take into consideration. So now, after the market left me with this inside formation, also I don't have to wait for the market to come to tap this area first and continue to go up. I can also take advantages of this movement coming down to this area of liquidity. So I'm going to the 1 hour time frame to observe the shifts. So if you observe clearly here, I'm having the shift on the 1 hour time frame, which is this one here. Also, I'm having an outside formation. I didn't have an inside formation. So this was my outside formation from the 1 hour time frame. Having to observe it from the 15 minutes time frame also, we are having this liquidity engineering. So this is my entry that is going to take me down to the daily area of liquidity before we continue to do anything else. So now, this now is my area where I'm going to take my entry. But also, I have to know my take profit on this area inside that daily area of liquidity. Also, I have to know where am I going to take the buys. So also I took this trade also based on the liquidity inducement here on this area right here. But it's actually on last year. So when I try to refine this entry so that we can actually see what happens on these levels, these guys just restrict me due to data. So this now is going to be my first, it's going to be my take profit. And when the market reaches here on this area, I'm going to buy again so that I can continue to go up to fill my area of monthly liquidity. So now this was my area. I'm going to put my entries, and this is going to be my take profit. And when I take this buy, I'm going to wait for the price to come and take this entry to this area, because each area of liquidity drives the market to a certain area of liquidity. The daily area of liquidity drives the market to the monthly area of liquidity. It happens all times. So the market came down. Market came down, as you can see. The market hit TP from the first entry, and then the market now activates the bullish entry, as you can see here. So you're going to take your trades based on this criteria, and also you're going to manage your trades based on the daily time frame. You have to observe the shift that are happening on the daily time frame. You have to observe the shift that are happening on the daily time frame. So if you observe clearly here, market continue to go up, as you can see, continue to go up. And now on managing it, as you can see here, when the market tries to do a transition, as I told you before, sometimes the market may try to do some transition, but it may not, it may continue to go up. If you see a transition, don't close your trades. You have to see a shift with an inside formation or an outside formation. Then you're going to close your bullion trades, and then you're going to maybe look for another opportunities. But as you can see here, we have this transition. It's just a lie. The market is trying to manipulate you. It's trying to discourage you. So don't close your positions. Wait for the market to perform a shift so that you can continue to go up. Also, we are this shift, but the market didn't confirm the structure, so you're also continuing to hold that trade. So this pair almost went, as you can see, but later on came and shift. So I'm going to take my profits on this 988 pips before the market try to continue to come down. Also, let us try to look last examples on the GBP-JPY. From this GBP-JPY, we had, try to look on the monthly time frame. Let me try to cut it somewhere here. So now, maybe I'm having this as my area of liquidity from the monthly time frame. I don't have to wait for the price to come to this area. If the market comes, I'll trade this area. But also, if I want to take maybe advantage of the market at the current price market, I'm in the current price action, I have to go to the daily time frame to observe the shift point that happened on this area here, on this monthly area of liquidity. Yeah. So now, the market performed a shift on this area. As you can see, this was my shift point from the daily time frame. And the market left me with an outside formation, as you can see. So now this is my outside formation from the daily time frame. But also, I don't have to wait. I don't have to wait for the price to reach there so that I can take my trades. I can also take advantage from the 1 hour time frame so that the market can bring me to this daily area of liquidity before I continue to sell as usual. So when I go to the 1 hour time frame to find my shift that should actually take me on this daily area of liquidity, here I am observing this as my shift point. And on 1 hour time frame, because these 1 hour time frames are the troubled areas, we can actually also take the shifts that are actually happening on this criteria as long as the market closed below the swing low. And what I mean by the market closing below the swing low, what I mean is that the market has to confirm the structure. For example, as you can see here on this, we closed below the weak point by a candle closure here. So it is safe for you to take your shifts from the 1 hour time frame. So now this was my shift point, and this was my area of liquidity from the 1 hour time frame. So this area of liquidity now is going to take me to the daily area of liquidity. So you're going to take your first trade on this zone from the 15 minutes time frame. So if you observe clearly here, I'm having this as my liquidity engineering here. So this is where I'm going to take my entry, and the risk is almost how many pips? The risk is almost 11.9 pips. So I'm going to put my pending order there, and I'm going to wait for the price to come and tap into it. The market later on comes, activated the entry point, as you can see here. So now I'm going to take these buys, but also I have to know where am I going to take my taking my selling trades. So if I come to the 15-minute time frame for refinement, I have to observe the last liquidity engineering that happened with this area. This was my last liquidity engineering. So here now I'm going to take my sales when the market reaches to this area. I'm going to take my sales. So now the market continue to rally. So now I know now that this is my first take profit here, and it's almost 524 pips. And when the market reaches to this area, also I have to take a sell also, so that I can continue to go down, because the market is fractal. The market follows the trend convoy cycle over and over. If you're able to master this cycle, you actually master the market. So you can actually trade at any market conditions. So here the trade actually started to run on this 1 hour time frame. I mean, from 15 minutes time frame, I try to go to 1 time so that I can speed up this simulation. So the market later on rallied almost, as you can see, a lot of pips. Market continued to rally. The market continued to rally. So as you can see, after the market reached to my entry, the market actually hit TP on the first entry, almost 524 pips. Then after now, the market activates the selling entry, and we are now start to continue to go down. So that is how we trade these agglomerations, these three agglomerations. If there's any questions so far, you may ask.
Okay, sir. Sir, you used a monthly time frame as a constant time frame.
Yes.
Can I use each 4 hour as constant time frame?
Of
and
course,
looking
you
for
can use,
shift and if I got any inside formation and outside formation, can I take trade?
for example, let me try to look for the recent trade from the hold that I took on previous week.
Okay, sir. Okay.
Let's say USD, it was from the 4 hours time frame. It was from and the market is continuing to go down until now we speak. So now we had the zone from the 4 hours time frame, which was located. Let's try to look at it. Was it somewhere here? Let's look at it on this area first. Was it 1 hour? Was it 4 hours? Let me try to remember it. The entry took based on the type. Yeah, it was somewhere here. Let's try to observe on 4 hours. We had an area of liquidity from the 4 hours. So if we observe clearly here, I'm having this now. This was my zone from the 4 hours time frame after the market performed a shift, left me with this outside formation, which was also a type 1. So based on the second agglomeration, which was the non-confirmation of liquidity flow, I waited for the price to come inside here and perform a shift on 30 minutes time frame. So after the market came and performed a 30 minutes time frame, as you can see here, this was my shift point. I was aggressive, so this was my shift point here on this 30 minutes time frame, and the market later on left me with also an outside formation, which was also this one. So now I'm going to use this zone to take my entries. So I took these entries from the gold based on this zone right here from the 30 minutes time frame. So you can use any time frame. You can use actually any time frame, as long as you just follow the sequence, you follow the rules, you can use any time frames.
Okay, boss. Okay, boss. This
Yeah.
is what I need.
Yes. So the entry was taken from the 1 minute liquidity engineering, which was located somewhere here.
I thought, sir, it is only valid for monthly on daily high time frame.
No, it's based on, actually the market is fractal, it is cycle. The market is fractal in nature. So you can use, even the weekly, you can use each and every time frame, yeah.
Sir, I asked you on the Instagram, can I take trade on the H4 as a constant time? You tell me
Of
You
course,
need.
you can take from the 4 hours time frame, but also you have to observe the true direction of the market. For example, if you observe clearly from the weekly time frame here, the market is actually continuing to go down. So you have to observe also the high time frames, what they're actually telling you, so that you can know now if I'm taking the 4 hours time frame, I'm taking it based on how the market behaves on these time frames.
Okay, sir. You tell me, sir. You need to know a liquidity consumption. You tell me. I remember this.
Of course, on liquidity consumption, after you finish this, after we do an assessment on this one, I will give an access to the FTA video. There is where I explain clearly this liquidity consumption and how to take advantage of it.
Okay,
So,
sir. Sir, I faced a problem most of the time, which is my major now. I don't understand the higher time frame trend, or that whether it's going down or going up. How do I choose it?
okay, let us try to discuss it clearly on this example. For example, if you want to know how the market actually behaves, these constant time frames, they are time frames that gives us the direction of the market. So for example, on this area right here, I am having my monthly area of liquidity, as you can see here. This is my monthly area of liquidity.
For you selecting area of liquidity, have you
Yes,
checked?
monthly. So now, if you see this area of liquidity from the monthly time frame, bear in mind and you know that the market has to come inside and fill this area of liquidity. So now, in order for the market to come down from the monthly time frame, I have to see a shift from the daily time frame, which is here. So now, if I go to the daily time frame and observe a shift, now I know now the market is in a bearish trend to come fill this area here. So that is how we know these directions. So now, if I come to the daily time frame and observe a shift and see maybe there is a shift point, as you can see, we had a shift on the daily time frame. So now I know this market is going down to fill this monthly area of liquidity. So now by just observing this area of liquidity and observing also a shift point on this daily time frame, now I know gold is in a bearish trend. I don't know if we are together up to there.
Okay, now the way you find out whether the market go up, or go down, right?
Yes, you actually know when the price goes up or goes down after actually observing this shift point on this constant time frame and also the situational time frame. Then after, now you can know now if this price is actually going down or not going down.
Let me tell you one thing. Honest, before I join you, I look at the market like this. Can you go to the monthly time frame? I
Yes.
show you.
Okay, well, let me go to the monthly time frame. Yeah, this one.
I look the whole back a data in order to get the direction.
Of course, that is not accurate actually, because the market has to fill some liquidities.
Now I understand. I understand how that trend.
Yes. So when you actually look at these areas, when you look at the market, you just have to observe the liquidities, and the market is just a slave to liquidity. So you know now the market has to come to fill the liquidities. So when you're in the monthly time frame, you have to go to the daily time frame now to observe a shift point. And I remember I took this trade also after the market performed a shift on this daily time frame here. So now we know now that the market, in order for the market to fill monthly areas of liquidity, it has to shift on the daily area of liquidity. Maybe let me try to illustrate here. In order for the market to come to fill the monthly area of liquidity, it has to shift on the daily area of liquidity. In order for the market to come to fill weekly area of liquidity, it has to shift on the 4 hours area of liquidity. It has to shift on the 4 hours area of liquidity. In order for the market to come to fill the daily area of liquidity, it has to shift on the 1 hour area of liquidity first. So as you can see here, the market, after the market performed a shift on the daily time frame, the market left me with an inside formation, but also the market left me with an outside formation. So I remember I took this trade here based on the it was from the 5 minutes time frame. So we took a sell on this area after doing some refinements based on the validation to violation concept. And this was our liquidity engineering. This was the entry that we took, and the market went a lot of pips, continuing to go down. A lot of pips, almost 817 pips was taken from this area before the market later on came again and tried to shift on the daily time frame again here. So that is how we observe direction of these prayers. Then after, we are going to take advantage based on the liquidities that are actually available.
Okay. Hey,
If
you tell me.
Yes, tell me.
You wanna. Okay. You tell me. You show me a GBP/USD right now. You take a trade.
Yes.
Hey, can you show me how do you take this trade?
The trade that you took on the GBP/USD.
Yes, sir. Yes, sir. I saw your Instagram story.
Yeah. The GBP/USD trade was taken from the weekly time frame. We had this area of liquidity here from the weekly time frame, which was located on this area. So in order for us to know now that the market is actually coming to fill these areas of liquidity, we had to observe a shift from the 4 hours time frame. So after the market performed a shift on the 4 hours time frame here, we now know that the market is actually coming down to fill this area of liquidity. But also based on the first agglomeration, as I told you, I have to observe the shift point on this area here, and the market performed a shift on this area here, and the market left me with this inside formation where I'm going to use it to confirm my liquidity flow. Later on, the market came, tap into my zone. Then the market performed another shift again, as you can see here. So after the market performed another shift now, I'm having also an inside formation, which is this one, which is also a type 1, as you can see it clearly, which is also a type 1. So this was my zone now, and I went to 3 minutes to put my pending order based on the reactive liquidity engineering. It is where I took my entry here. But also, after taking this entry, this buying entry here, also I took a sell from the 1 hour shift. From the 1 hour shift. This was my shift point from the 1 hour. And also,
there has no any inside formation. How do you?
There was inside formation on this area. If you look clearly on your MT4, you can see it. But let me try to look maybe on another saver like maybe FXCM, because sometimes these brokers actually manipulate these things. Just try to look maybe on FXCM. As you can see here, I'm having this one as my zone.
Yeah.
So these brokers actually sometimes I don't know, they try to manipulate these zones or whatever. But this is how I found it also on my MetaTrader. So when you come to refine it to a 15 minutes time frame, you're going to take your entry based on the liquidity. I took it about based on the liquidity flip. I remember based on the liquidity flip. Actually, it was located on somewhere here. I don't know why these brokers are actually doing this, but this was the liquidity flip was available on this area here. I don't know if I remember if it was from 1 minute or 3 minutes, but that is where we took the entry. But also, even if you marked this as a liquidity flip, as you can see clearly here, we are having this liquidity engineering, but also the market came and stopped it by also a momentum, as you can see. Also, this was also a place where you could have taken your entry also. So the market later on came and tried to tap to that area. So that is where you are going to. That's how the trade was taken based on this pair. So the market is continuing to go down until today. But later on, I'll come to teach you based on the correlation concepts how these pairs. I'll give you access to the correlation concept video to know how to take advantage of these pairs, because sometimes if you buy gold, you don't have to sell pairs like Euro USD or pairs like GBP USD, because these pairs are actually correlated a lot. So it's about the correlation concept. I'll give an access to the video. You actually will study it. Then after, everything will go on as usual.
I also wanted to ask you this question. First, I took a screenshot from your Instagram.
Yes.
How you said your trading view. I have a screenshot. I send you later. You will know what I wanted.
Oh, you're sending via Telegram?
Yes, I will send you later.
Okay, you can send me. Let me try to check it out.
Sir, I have a question. I forgot to ask you, sir. Sir,
Okay,
you send me a video directional bias. We- we- I have to look for a weekly trend, a
yes.
higher high higher. Then I have to find latest validation and invalidation point. I fail to most of the time. I fail to choose this. Can you show me an example? Just one example,
Okay, let us try to look maybe one example.
if you have it.
Just try to look, maybe I took an entry on this. I remember it was out on the D. I remember it was on the daily time frame. I think I took a lot of pips on that trade. I think it is somewhere here. Try to mark it maybe somewhere here. Okay, I had this as my zone. Now we are talking about the indomitable. Then I'm going to find my liquidity engineering from the 1 hour time frame on this area. Then after I'm going to wait it for the market to come to tap it first before I can continue to. No, it was from the above. I remember it was not this area. It was from here. Yes, yeah, I get it now. It was from this shift point here. So I was having this one as
I
my
have a
zone.
question.
You can ask, bro.
Sir, I get too much confusion at this level. Like, whether I chose this or chose this, which one I chose, and how do I choose?
When talking about the shifter and talking about the normal directional bias.
Yes, yes. Eh, After shift, we have this
For
inset
example,
form.
for example, we have this shift point here, and we have
Yes, yes,
inside formation also, but also we have
yes,
an
yes,
outside formation also.
yes, yes, yes.
Here we are actually using both. We will use this one first. If the market comes and stops this out, we are going to use this one as our last one.
Okay, okay.
We're actually going to use both. But after the market performed the shift and the market left you with this inside formation, and also the market left you with outside formation, then the market continues to go down and create maybe a new low, for example, like this one. Now on this here, you have to observe for the type ones only, because this zone actually, they are very, very confusing. It's better to observe the type ones. So you're going to observe the type ones until you see the market has already performed a shift again and left with another formation. Now you're going to use this formation as usual.
Okay, sir.
Yeah. So
Sir,
based on the indomitable, this was our zone, for example, the trade that I took. I remember it was, yeah. On the 1 hour time frame, we had this as the reactive liquidity engineering here. Later on, the market came, tap into it. After the market taps to this area, the market left us with this liquidity engineering from the indomitable based on 15 minutes time frame. So now this was my liquidity engineering. So based on indomitable, I'm going to take that entry as long as the market has already confirmed the market has already do some indomitable here. So this was my entry, and the market continued to go down like that. So you wanted an example from the indomitable, that is one of them. So the market continue to go down like that. Yeah. So I'm going to give you access to this video. I'm going to give us this video, you'll watch it. Then on the next session, it will be an assessment session. Actually, I'll give you maybe a week to find me actually 3 examples of the first agglomeration, which is the confirmation of liquidity flow. 3 examples, confirmation of liquidity flow. Also, another 3 examples on the on the normal areas of liquidity using validation and violations. But also, even if, because actually we actually skip this non-confirmation because actually it is very understandable if you actually manage to understand this confirmation of liquidity flow. So this non-confirmation is just an extra, so it's not a big deal to match. But the main concept I need to see if you are actually understood clearly is for the confirmation of liquidity flow, but also the normal area of liquidity with validation and violation. As a normal liquidity flow, if you remember, let us do a little recap on the confirmation of liquidity flow. Here we was actually looking from the market maybe performed a shift, left us with this inside formation. We are going to hit this here to find maybe the shift from the situational time frame, maybe the daily time frame, then wait for the price to come later on to try and tap this area, then after that to perform another shift again. So now the market later on comes to that zone after the market performed the shift, takes the entry, then after the market continues to go. This is just from the confirmation as we studied. Also from this normal area of liquidity, using validation and violation aggressively, we are talking about how to not wait for the price to come. For example, we are having this maybe as an area of liquidity from the monthly. We are actually waiting for the shift from the daily time from this year. So it will show me maybe a shift from this daily time frame, but also, even if we're not waiting for this shift now, we are going to also look from the shift from the 1 hour time frame again. So we are going to sell the price here on the 1 hour time frame. Then after, when price reaches to this daily area of liquidity, we're going also to buy again until we reach to the monthly area of liquidity. So I'll give you this session to this video. From the next session, it will be an assessment session where you will be the host. You'll send me the link. Then after I'm going to join, then after you're going to explain to me these scenarios on these 2 sections from the confirmation of liquidity flow by 3 examples, and also the non-confirmation of liquidity flow. I mean the normal liquidity with these three examples. I don't know if we actually clear up to there. I don't know if you get me clearly.
Okay, sir, I understand. Sir, I have to make assignment about a confirmation of the liquidity flow and normal
normal area of liquidity, normal area of liquidity. This one, that's why I was actually trying to illustrate here.
Then that's all I have to do, right, sir?
Yes, but the assignment, you don't have to send me the assignment. We will enter in a Zoom class where you will be the host. Then after you'll explain to me how you actually do, how you actually trade these 2 concepts, how you actually understood them, then and how you approach the examples.
Yes, sir. Sir, we have covered today a confirmation of the liquidity flow, a normal area of the liquidity flow, and agglomeration 2 have not covered, right, sir?
We have covered with the second agglomeration, we have covered it on the non-confirmation, which actually explained to it when maybe the market has to maybe come to an area of liquidity, for example, like here, and you don't have to confirm the liquidity flow. You just have to wait for the price to shift, where we look about the examples on the pairs like Bitcoin, on how it actually performed a shift without even confirming the liquidity flow here. Then the market later on comes and taps into the entry point. So that's why I said to you that this just extra. You don't have to deal with it a lot. But the main concept here is this confirmation and also how we trade on this normal AOL using validation and violation. Yeah.
I have last question, sir.
Yes.
Sir, do you use big pair for agglomeration only?
Sorry, I didn't hear you clearly. You can repeat your question.
I asked, do you use this agglomeration for only a specific pair, or it work all pairs?
Actually, this works on all pairs, works on the cryptos, works on the indices, works also on the synthetic indexes, those volatilities pairs. So it works on each and every instrument. It's just waiting for the rules to happen. Then after, you're going to take your trades based on the criteria that you're actually using all day, every day.
Okay, sir. Okay. And just send it to me, hey, so that I can watch it.
Okay, I'm sending you right away. I'm uploading it, and I'm going to send to you right away, right now.
And send to me correlation concept.
Okay, no problem, brother. I'm sending you right away.
Okay, sir. Okay. Thank you so much for this.
Okay, thank you too, brother.